I'm Owen Bigland. This is the Inside Edge video blog. Wanted to move on to chapter 6 in my new book, Along for the Ride, available on Amazon now. Chapter 6 is entitled How to Think Like an Investor. And in this chapter, I kind of move from real estate investing into other ways to diversifying your passive income flows. And the next best way after real estate is through buying equities, stocks, investing in the stock market. And this chapter, I kind of channel the greatest investor of our lifetime, which is Warren Buffett. I always kind of have a soundtrack of Warren Buffett quotes going through my mind when I'm looking at stocks, analyzing, reading annual reports, and thinking about purchasing a new equity or a new position in a company. And one of the couple of the quotes that I'm always thinking about with Warren Buffett is he often would say that you want to buy, first of all, companies that you understand, companies that are profitable, and you can easily figure out how they make money. And he used to say that you want to buy companies that a ham sandwich could run these companies and still make a pile of money, because eventually, over time, a ham sandwich probably will end up running the company for a short period of time. And I always laugh at that because it's so true. And a prime example recently would be McDonald's. McDonald's, if you've bought my book, you'll know that I dedicate half a chapter in there to McDonald's and how wonderful a company McDonald's is, really. McDonald's, if a lot of people don't realize, is actually a real estate company disguised as a hamburger company, food business. A lot of people don't realize that McDonald's business model is absolutely brilliant. It's about as perfect as you can get. McDonald's buys all the real estate. They own all the stores. They buy the land, build the restaurant, and then lease it back to the franchisees, and then take a 4% cut on all the profits of the franchisee. It's an incredible business model. The other thing with McDonald's, a lot of people don't realize, is all the real estate they've accumulated over the last 40 years in places like Paris and London and Manhattan. Most of that real estate is held on the books at cost, which is just crazy, the amount of untapped asset they have, which has never been realized on McDonald's books. Maybe one day they will, but think about it. They've got restaurants in Midtown Manhattan, New York, that they might have paid $750,000 for back in 1978, and it's on the books at $750,000. That's probably worth $10 or $12 million today. Now, McDonald's is another example of a company. I've owned it for about 20 years, and it's been very good to me over the years. As a matter of fact, just going off track here a little bit, a lot of people, of course, know the values of what Vancouver Real Estate has accumulated or has appreciated over the years. But it's funny, if you take a look at a lot of good American dividend-paying S&P 500 stocks like Pepsi or McDonald's or Coca-Cola, Johnson & Johnson, Procter & Gamble, many of these companies, if you would have invested, I saw recently, if you would have invested $10,000 in Pepsi shares in 1973, today those shares would be worth about $5 or $6 million if you reinvested the dividends. Now that's a pretty good return. That's a kind of return that makes Vancouver real estate appreciation look like a pittance. So I always laugh when people think, oh, the prices are unsustainable in Vancouver real estate and what they've done over the years. Well, they should really have a look at what some good S&P 500 stocks have done over the last 30 or 35 years, and it'll blow you away. But back to McDonald's here quick about the quote from Warren Buffett, how a ham sandwich will eventually run it. And it's totally true. Back in the late 80s and 90s, when I first started buying McDonald's shares in the early 90s, the CEO was a guy by the name of Jim Skinner, who was a fantastic CEO, and McDonald's was on an incredible roll there, creating incredible value for the shareholders. Then in 2012, he retired, and a new CEO took over. I won't mention his name here, but he was the ham sandwich. Fortunately, only lasted about 3 years, but McDonald's shares went from about $120 a share down to the mid-80s during his tenure. Fortunately, they had a new CEO that took over in 2015, a guy by the name of Steve Easterbrook, who has now completely revitalized McDonald's, and the share price went from $88 back up to close to $155. So we're back on a roll again here with McDonald's. The other philosophy, or the other soundtrack I have of Warren Buffett, one of his other great sayings was, you only want to buy companies that you feel good about buying today, and if they closed the stock market for the next 10 years and you weren't able to sell those stocks for at least 10 years when the stock market reopened, you would still feel comfortable in buying that company and not having the least bit of regret and not losing a night's sleep over it. And I try and remember that every time I either buy a new position in a company or I top up my existing holdings. Does that still hold true? And it's the exact same thing I do when I buy investment real estate or even a principal residence in Vancouver. If you were to buy that Yaletown condo today, and they were to close the MLS for 10 years and you weren't able to sell the property, would you still feel good about buying, or would you still want to go forward with the deal? And you should always look at that way, and it goes back to what I've been talking about on my blog for the last 7 years here, how you always want to keep a long-term holding period. Real estate is forgiving and it's foolproof if you just give it enough runway. That runway, in my opinion, is always 8 to 10 years. Keep it for 8 to 10 years and you wish you would have bought 2 of those properties. In the short term though, anything can happen. You could buy that Yaletown condo today. 3 years from now, you pay $500 for it today. 3 years from now, it could easily be worth $450. But I can tell you 10 years from now, pretty good chance that it'll be worth more than $500,000. You just need that runway in the first 8 to 10 years to ride out any short-term market fluctuations, which are always going to happen. They're normal. But the same thing with stocks. I buy a stock that I know if I buy it today and they close the stock exchange for 10 years, I don't worry about it in the least. I know it's going to be worth far more 10 years from now. So just to give you a little example here, in my book, in chapter 6, and in the back of my new book, I give you guys my portfolio. I show you all the core holdings in my portfolio. The companies like Johnson & Johnson, Procter & Gamble, Merck, all the big Canadian banks, McDonald's, Pepsi, Apple. But just recently, I can tell you, over the last 6 weeks, we've seen some corrections in the stock market, in the S&P and in the Dow, and I've picked up a number of, added to a number of my core holdings. All these companies I own, but they went on sale due to various things, the Korea nuclear threat, Amazon starting to encroach on some of these companies' business. So you can get some short-term, some fantastic buying opportunities. So I just picked up a number of things. Home Depot, I just added to my portfolio on. 3M, United Technologies, Costco, and what was the other one? And McCormick. Now, if you read my book, you'll know that these are all core holdings for me. They have been for a long time, but I was able to pick up a lot of these stocks on sale, where they were off 5 to 10% from their 52-week highs. The thing with a lot of these companies I just named, they never are screaming bargains. The PEs seldom get below 20, but they are incredible long-term income-generating machines that you keep. I buy it today. If they close the stock market 10 years from tomorrow and didn't open it for 10 more years, I'm not losing any sleep on those stocks that I just bought. So that's the way you always want. That's how successful investors think. It's always long-term. They buy a company that a ham sandwich could run and still make an incredible amount of money with. They buy companies that if you bought it today and they close the stock market tomorrow and didn't open for 10 years, you're still comfortable in buying. And you can translate that to Vancouver real estate as well. You buy it today, they close the MLS, hey, you still have no regrets about buying that property. You know, I've gone back and I've told clients this over the years. I've bought a lot of investment properties over the last 30 years. And I went back and took an audit of some of the properties I bought, dug out the files on them, and some of them I can't remember all the logistics of it because it's been so long since I bought them and I've been holding them. But I would say probably half of the properties that I've bought over the last 30 years, probably about half of them at one time or another were worth less than what I paid for them. Now, I can tell you that they were worth less. It's generally in the first 3 to 5 years. I think the longest one I had that I owned that was underwater slightly, not very much, was close to 6.5 or 7 years. And then, of course, it recovered from there. I had several that would go up, come down, go back up, back down again in about a 6-year period, and then finally go off to the races here. But those underwater or less than what you paid for it usually occur in the first 1 to 5 years. But my philosophy is always that 8 to 10 year window. That's plenty of time to recover from any short-term fluctuations. And that's the way investors think. That's the way successful investors operate. And you should too. Again, a lot of this is in my book. This is chapter 6, and then I go into it in more detail in some of the other chapters as well on how to buy and start collecting cash flows, either through dividends or through investment properties. I'm Owen Bigland. As always, thanks for watching. If you haven't subscribed to my YouTube channel, please do. Make sure you get all the blogs every week that I update. See you next week.